Great. So guys, we are live here on our Friday night wealth creation course. I want to thank everyone for tuning in tonight. We are set up with a new mic system tonight, and we have some issues with Facebook connecting to Zoom. So I want to just let you guys know, if you're on Facebook and you'd rather be on Zoom, you can go to our Zoom link. You can get the link for that from Nano, from Lexi, from Arian. Anyone on our team can get you that link. But if you're just tuning in for the first time, this mic thing is new and weird. If you're just tuning in for the first time, my name is Jerry and I own a company called Wealth Dynamics. And what we do here is we help educate people on finances. Okay, so we help families become educated on finances. We help them build wealth. We help them navigate their economic futures with freedom. And the purpose of that is to help provide certainty in people's lives. Okay, we want people to actually have financial certainty where they know what they're doing. They know why they're doing it. They know, the mechanisms that are at work with finances, rather than feeling like they're guessing and they're in mystery their entire lives and not winning with money, which statistically speaking is most of America, right? So most of America is not winning with money. So we have this thing here where, 80% of our population is paycheck to paycheck. We have record debt. We have people that have extremely high debt to income ratios. I think 60% of people have less than $1,000 saved. So when we look at the stats, America is not winning with money. Okay, which means that we're lacking knowledge. There's something that we don't understand on the actual topic of money itself. Otherwise, we wouldn't be losing with it. It wouldn't be something that we struggled with if we had all of the knowledge and all of the information about it and we knew everything. But the funny thing is a lot of times we act and operate like we do know everything. Okay, we act like there's nothing to learn about finances. It's a topic that when it's brought up, many people try and avoid. And it's something that, if it's talked about, it's taboo. And so one of my reasons that I do these courses every week is because for me, that's how it was. I didn't learn about money growing up. Okay, I didn't grow up in a family where we were financially literate and doing well. It wasn't a topic we went over when it came up. It was, my parents usually fighting about money. And so that's not something that I grew up with, like good examples and good knowledge and everything. And so tonight I'm going to cover credit. Okay, I'm going to cover credit. And my story with credit is because of my miseducation or lack of education on finances. Credit was one of the first traps that I got stuck in. Okay, when I talk about the blueprint to financial freedom, one of the first things I talk about is the traps. What are the traps that we go through when it comes to money? What are the things that, if we're not watching out for, are going to stop us and slow us down? And they're intended to do that because our lack of knowledge is being preyed upon, right? So these are all things that I focus on with my clients. I focus on with my company. And so I'm going to go over this tonight. Now, when I talk about credit, I'm going to tell you guys my story. When I talk about credit, the very first time I ever got credit was a car loan. Okay, you may have heard this story before, but I was 19 years old. I had a little beater, and in Alaska, a beater is a car that basically runs and has heat. Right, that's it. There's not a whole lot past that. So basically, I had a beater, and the beater broke down, and so I had to get a new car, and I didn't have money saved to get a new car. Right now, I want to pause there because that's where this started. I didn't have money saved to get a new car. Right, so I had to borrow money. My reasoning was I don't have 10 grand, so I can't go buy a car that's going to run through the wintertime and everything. But I do have income, and I can borrow. And I can spend $300 a month or $400 a month on a car payment. And that's how I justified and made sense of doing that. And so then I had a car note. I had a car loan and I started making payments on it. That was my first experience with credit. Okay, easiest thing in the world too. I went to the car dealership, and let me just adjust my Facebook screen there. I went to the car dealership and I walked in and I had my mom co-sign with me. And so she co-signed and I got the loan and they approved it. It was like 9% or 10% or 11% interest. And they're just like, yeah, if you can make these payments, you can have this car. And I'm not going to say, no, I can't make the payments. So of course I told them I could, and I bought the car, and that was that, right? My second experience with credit was getting my first credit card. Okay. Again, it was a thing where I didn't have money for something. This time it was business. And so I got a credit card with the expectation that I'm going to be able to charge things on this card, and I can't afford them now, but I'll be able to afford them later. Right. And this is kind of the premise behind our mindset with credit. It's kind of like the shortcut. It's like, well, you don't have to have money if you have credit. See, that was my mindset. I was like, well, I can borrow money on this car because I don't have money for a car, and I don't have to because that's what credit's for. Or with the credit card, I can borrow money on this credit card because I don't have money, and I don't have to have money because I can use this credit card. And it's one of those things where, because it's permissive, meaning it's allowed by the banks, by the institutions, because they'll allow it, we think that that means that it's okay. Okay, realize that if somebody says something is okay, I've got to first look at, do they have my best interest in mind? Right? Because if they don't, and they're telling me something is okay, that means it might be okay for them, but not for me. Right? I didn't know any of this stuff. So I'm just like, oh, well, the banks will approve me and it's cheap and free, or whatever the justification was on how I was going to borrow money. And so that was all I did. I borrowed money, and that was that. Right now, what happens with credit is people get in this mindset of either consumer spending, where we have, income that doesn't surpass our expenses, and then we start borrowing money. That's the root. Lack of income, lack of money. And I talk about this when we teach our clients on how to get rid of debt. And really, like, we're about wealth. So our goal is passive income that exceeds savings, expenses, and taxes. Passive income that exceeds savings, expenses, and taxes. And so when I started my business, I was focused on, we have to get people there. And so we're going to get there by investing. Then I realized, shoot, most people don't have any money to invest. So we had to undercut that. We had to look at what's the thing that comes before, because we need to help people get to a point where they could invest. Then we're like, okay, well, people need to be saving money. So we got into, all right, let's get self-directed IRAs and 401ks, and let's do the sacred account. And then we realized, shoot, people can't even save money. Okay, so then we had to undercut even further. And it was like, well, why can't people save money? And most of the reason is debt. Okay, and then we had to look at, okay, well, we teach people to pay off debt, but for some reason they still like it and they think it's a good idea. Right? I can't tell you how many times I've heard, well, I don't want to pay off my car loan because it's only 3%. And that's cheap money. Or I've got a student loan that's got 0% payments right now and it's deferred, so I'm not going to pay it off. That's not like financial intelligence. It's almost like a crack addict, like a drug addict. Like, we get so hooked on interest and credit and finance that when it comes time to remove it from our lives so that we can start earning interest instead of paying interest, like, mentally, for some reason, we just, as people, can't wrap our minds around it. We start justifying the loan. Well, it's cheap money, or, it's not that much per month, or, it's a pretty small debt and I could pay it off, but I don't want to put my money towards paying off debt. I would rather keep it out and use my cash elsewhere. So we have like this thing with debt. And so I had to look at, well, how do we undercut debt? Why is it that people are hooked on debt? If you look at the stats right now, like, what's going on there? Right? And so what people don't realize is, when I have an income, okay, because I'm not like, if I'm an average person, I'm not a bank, I'm not an institution, I'm not rich dad, poor dad, I'm not these influencers you see on Instagram or these people you see on CNBC, right? I'm a person. And as a person, I have income and I have expenses and I have assets and I have liabilities, and that's it. Right? So when I start measuring, how do I get ahead with finances, I have to start looking at my financial statistics. And my financial statistics are going to measure things like, how much passive income do I have in relation to my active income? How much passive income do I have in relation to my expenses? Right? Or if I'm looking at my savings, what is my savings rate, percentage of income being saved in relation to my debt to income ratio or my tax ratio, right? There's these numbers we can start to measure and say, if I'm not investing, it's because I'm not saving, period, right? And if I'm not saving, it's because my money's going somewhere else. And if I start measuring where else is it going, that's where I can see, hey, I'm paying, 25 or 30% of my income towards debt, and I'm paying 10 or 15% of my income, maybe more, towards taxes. And if I could get rid of those things, then I can actually start to save money and invest. So this conversation of credit isn't even about credit. We're not hucksters saying you need to, buy credit repair and it's all about 0% business financing and that's how you're going to get wealthy, is take out loans with no money down. That's bullshit. That's not how it works. Okay, those are literally just like scam artists. Like, you'll see that all over the internet. I had a guy today sign up for my credit program because he's like, yeah, the guy I signed up with, which when he signed up, I was like, that dude's a scammer. You're going to get scammed. I guarantee it. My client didn't listen to me, right? 2 or 3 weeks later, text me, yeah, you're right. The guy is a scammer. I'm getting a refund. Let me sign up with you instead. Okay, so this conversation of credit is an undercut to why aren't we saving? Right? Why aren't we saving? It's because we're borrowing. And when we're borrowing, it comes from lack of income and lack of money. But if we've already borrowed, we have to get rid of that money that we've borrowed, that debt, that outgoing expense, so that we have the income freed up to then start saving and investing. Right. And this is not Dave Ramsey beans and rice. It's just math. Like if I'm making 10 grand a month and I'm only saving 2 grand a month, and I would like to save 4 grand a month, and I have 2 grand a month in debt payments, if I could get rid of my debt, I now have my 2 grand a month. And it's guaranteed. It's not something I have to hope for or speculate upon. So when we start talking about credit, first off, the first way to win with credit is to win with money. Okay, because there's different levels of credit. There's payday loans for broke people where they charge you 700% interest because you're broke and uneducated, and so they're going to take advantage of you. That's like the very bottom level of credit, right? Then there's subpar credit. There's people that have subprime loans that the bank doesn't expect them to pay the loans back. They kind of already know the person's going to default, so they're usually going to charge you an exorbitantly high interest rate. That was my car loan. Then you have kind of like okay credit where you're going to pay 4 or 5 or 6%, and you might pay 10 or 20% on credit cards. And then you get into the threshold of you actually have money. When you actually have money, then you get into like consumer credit, where banks will give you airlines points, and they will give you cashback rewards, and they will give you different things to incentivize you to use their credit card. Okay. So if I'm at the very bottom, I shouldn't be using credit, because I'm not even using money. Money is senior to credit. Credit doesn't exist without money. Credit doesn't. There's a quote from JP Morgan. He said, gold is money, everything else is credit. Okay, so if I don't actually have money in solvency, I don't need to be borrowing. Okay, this is called investing while broke. I see this all the time. The crazy-eyed people that watched too many Robert Kiyosaki videos, and they're trying to flip a house on a 0% credit card when they don't have money in the first place. That's not where I need to be at that point, right? So credit happens in a gradient system of, this is when I start using it. And if I'm not in this position, I shouldn't start using it, because it is a trap, right? Anyone that's charging me 700% interest on a payday loan, that's a freaking trap. Right? Anyone that's charging me, on subprime credit because they know I suck at credit and they're going to use that against me, that's a trap. I don't need to be involved in that. So the first way to get good credit is to be good with money. Earn more than I spend and own more than I owe. Those are literally the first keys, because I'm going to get into like when you actually do start using credit, what they're actually looking for. What are they actually looking for? Because prior to that, if I don't have income, then I'm gonna either not get good loans, I'm gonna overpay an interest rate, right? Or I'm not gonna get loans at all. So what I'm saying is a lot of us, we use credit because we're not good at money, because we don't earn more than we spend, because we don't have assets that exceed liabilities. So then we borrow, and now we owe, and now we have more and more of our income going towards expenses, towards interest and principal payback. And ultimately that stops us from saving, which then stops us from investing, which then stops us from having passive income, which takes away our financial freedom. You guys see that system? So for me to sit here and say, I'm going to coach you on how to get credit and 0% lines, when I know most watchers are not good with money, that would be wrong of me. Let's get good at money first. Earn more than you spend, own more than you owe. Then we start working on credit. Now, a lot of us have already borrowed, like I said. So we're in now the position of we're paying off debt. We're getting rid of the past mistakes of us buying things that we couldn't pay for and having to borrow money to do so. That's where the sacred account comes in. We use that to pay off our debt, and we have the ability to self-finance and buy our debts back. And then later on, we can still have that money growing, right? But what happens is when we start doing this, it takes a while. Okay, the average person has about 15 grand in credit cards. They might have 20 or 30 grand in car loans. They might have 30 to 50 grand in student loans. They might have $5,000 or $10,000 in medical debt. Shoot, they might even have some tax money that they owe to the IRS. They might owe family members or friends. They might have a line of credit out, right? So when we total up and it's, $50,000 or $100,000 or $150,000 of debt that we're paying off, and we're swinging with, $100 a month or $1,000 a month or $2,000 a month, it really doesn't matter what the number is. It takes a while. It's not instant. See, that's the thing with credit is we get into it instantly. We don't get out of it instantly. The banking institutions, their game is that it's easy to get in and it's impossible to get out. It's a mouse trap. It's a rat trap. It's easy to go and grab the cheese, but once you've got the cheese, it's not easy to leave the trap. Okay. So part of this is just by nature of interest and principal. If it's going to take a little while, that means that the entire time I have principal and interest compounding, right? It's growing. My interest is being charged up. The longer it takes me to pay these loans off, the more I'm going to pay in interest. So how do we get around that? That's the question. And this is where, when we start paying things down, what my company does, what we teach our clients to do, is we pay things down to a certain level. At the same time, we're going to improve your credit. And I'm going to go through exactly how to improve your credit. It's not magic. There's no secrets. All of these marketing buzzwords, unfortunately, tonight, you're going to find out that they're scams. But I want to go through it with you guys because it's something that is important. And what happens is either uneducated people get taken advantage of it by it, or taken advantage of by it, meaning they don't realize that there's no such thing as primary authorized user trade lines, or they don't realize there's no such thing as a credit sweep. So they overpay, influencers, marketers who really don't know jack shit about credit repair to then repair their credit, and then nothing really happens with it. Or they fraudulently get their credit repaired and fraudulently get credit, and then it bites them in the butt later when they go to do deals with the big boys and they can't because they committed fraud, right? Or the flip side, the educated people give it no credibility. They don't heed any credibility to it, when really these are things that could help you, right? So if you've got a 680 credit score and you're like, well, I don't have a lot of debt and I just don't use my credit very much, and so my score is not very high, and so I don't think I need credit repair, and I don't think I need credit help, and I don't think I need to work on my credit or pay someone to help with my credit. These people will write it off because of all the garbage that's out there. Like, you can tell when somebody is just lying to sell their product, right? So these people that have good credit are intelligent, because if they weren't, they wouldn't have good credit. They're making good decisions. They can tell when something is a scam. And so unfortunately, they see this stuff being marketed and they're like, no, that's not for me. Okay. I'm here to tell you that I'm good with money. And I also worked on my credit. I hired people to help me with my credit. I hired people to learn about credit because it is an important part. Once you're solvent, that is the key. Once you're solvent, if you're insolvent, it is not an important part. You shouldn't be using credit. It has no place in your life. Okay. If you're broke, you should not go borrow money from somebody. You need to go earn income. You need to save. You need to have assets, right? So let me dive into what we're going to do here. And unfortunately, again, guys, I couldn't connect Zoom and Facebook tonight. Facebook came up with a cool new invention where Zoom doesn't work. Hopefully they fix that next week. So I'm going to be covering some content here on Zoom. And if you're watching on Zoom, you guys will see this. If you're on Facebook, unfortunately, you're not going to see it. You can move over to Zoom. Lexi, Nano, Arian, anyone that's watching that's got Zoom on the access link, go ahead and drop the link in the comments if you can. That way people can get on. But basically what happens here is, if we're trying to repair our credit, we have debt. Right? We have debt and we're trying to pay off the debt. Okay. And Chris kind of hit it on the head. The goal here is we're going to pay down our debt. When we pay down our debt, that naturally will bring our credit up. Thank you, Nano. Nano just dropped the link. So if you guys are on Facebook and you would like to make an exodus over to Zoom and actually be able to see some of the stuff I'm going over, click the link Nano just posted. But if I have debt, as I pay down my debt, naturally my credit's going to go up. Okay, a big part of credit is utilization ratios. If I have a lot of credit card balances that are charged up, and let's say I have, $100,000 in credit cards and I'm using 70% of it, my credit's going to suck because I've charged my cards up. So that's instantly going to show the credit bureaus, which are reporting agencies, that this person uses a lot of their credit and doesn't pay it down. That makes me a financial risk. Right? So I have debt. I'm paying my debt down. Naturally, my score is going to increase. So that's the first main thing. Solvency will make your credit go up. The other thing is, I might have some mistakes that I made on my credit, right? I might have late payments. I might have too many inquiries, right? I remember when I first learned that I could just apply for credit cards. I started applying for every credit card I could find. I was brand new in business and I was like, I need to get, plane tickets and marketing. And I need help with things that I have to buy that I don't have money for. So I just started whizzing out and applying for credit. I didn't realize every single time I did that, it creates on my credit something called a hard inquiry. Okay. A hard inquiry means that I was asking for money and it was official. And whether I got declined or rejected, it means that I was asking for money. When I have too many of those instances, the credit bureaus look at that and they say, that's a high risk individual. They asked for money 12 times in 3 days, right? There's nothing special about those numbers. I'm just saying you asked for money a lot. If I send out lots of requests for credit, that's going to reflect badly on my credit as well. So I have things like late payments, missed payments, non-payments, charge-offs, inquiries, like all of these things that we end up having on our credit. Usually when we borrow, because we're broke, these are usually the root of that is we were broke when we borrowed. We already weren't good at money. So surprise, the bank gave us money and we weren't good with it. Like we weren't good with it in the first place, right? So it results in these negative items on credit. So once we start paying the debt down, we then start removing the negative items off the credit. Okay. The way that this works is the credit bureaus, they sound very official, but they're not government agencies. They sound like they are. FICO, Experian, they're called credit bureaus. So you're like, oh, this must be the Bureau of Credit. It's not. They're private organizations. Okay. They report your credit. They collect data about your credit and your history and your habits, and they formulate that into a score and a report. And they basically provide that so that banks can kind of get like almost like behind the scenes look at your financial life before they decide to loan you money. So since these credit bureaus are private companies, not public agencies, they're not working for the public good, there's a law, it's called the Fair Credit Reporting Act, and it basically says, hey, like, because imagine if I'm a credit agency, right? Let's say I'm a credit agency and this is me, right? And I'm lord of everybody's credit and I can put whatever I want to put on their report. What if I was a racist? And I was like, man, I don't like insert race here, white people, black people, Asians, Indians, whatever. And so because I'm a racist, I want to make all of their credit bad. So I'm going to put stuff on their credit to ruin it. Or what if I was just didn't like certain groups? Like I didn't like poor people and I thought that they were, a risk to borrow, to loan money to. So I'm like, I'm going to put stuff on their credit so that they don't get loans. Right. And I'm not saying this is what they do, but what if, right? That's not fair. Because you don't have any say. You're the consumer. You're like, hey, just because I'm this person or I have this circumstance doesn't mean I shouldn't get credit. So laws and rules came out saying, hey, you have to fairly report on credit. You have to fairly report on these credit agencies and those bureau reports because this individual has every right to fair credit just like someone else. So if it's not true, it can't be on the report. Okay, this is critical and key. So when we start repairing credit, we have debt. We have some late payments. We have some charge-offs. We have some inquiries, right? So what we do is we end up going through and we look at all these negative items on credit. And the first thing we're going to do is we're going to say, are any of these fraudulent? Meaning they're not supposed to be there. They're illegal. I had fraudulent reports on my credit 2 years ago. Okay, I had a business partner of mine from a past business, not even associated with me. He had debt. And for some reason, the credit agency tried to associate me with the debt. They put it on my credit. That's fraudulent. That's not my debt. I had nothing to do with that company, nothing to do with the LLC. They cannot put that on my debt. And it's an LLC. So that's a breach of the corporate veil. The LLC's purpose is so that they can't do that. So I went and I saw that this charge off, because that's what they were saying is this debt was, uncollectible and we charged it off. So I went and said, that's fraud. So there's a company we work with that provides legal assistance to our clients. And we basically go to the lawyer and we say, hey, this is fraudulent. Can you help us get this taken off? So we go and we take off any fraudulent stuff that gets pulled off the credit immediately. Now, here's what I want to caution you. If you're hiring credit people and you hear them talking about the credit sweep, what they're typically telling you to do is they're telling you to say that everything on your credit report is fraudulent. Guys, that is illegal. That is a federal crime. That's how you go to prison. That's how you get, penalized and pay fines and public civic fines. So what will happen is if it's a legitimate identity theft or fraudulent thing, I can say it's fraud. I can file a police report, and then the credit bureaus have to take it off my credit. Okay. Now it's on the honor system on if I'm actually truthful that it was fraud. So this is where it gets messy and gross is people in this industry, they'll use that. They'll say, hey, I know you have 10 late payments and I don't know if they're fraudulent or not. Usually they'll bait you. They're like, I'm not telling you to commit fraud. I'm just saying highlight anything you want to have taken off that you think should be taken off that might be fraudulent. And whatever you highlight, we're going to turn in and get taken off. So if I'm an unethical or uneducated person, I'm going to freaking mark off all 10 things. I'm going to say all of these were fraudulent when they weren't, right? Maybe only one of them was. But if I tell them all 10 are, and then I file a police report, and then I go to the credit bureaus and I say, hey, this was fraud or identity theft, all 10 of these items need to be taken off. Well, the credit company's not going to argue with me. They're going to take it off my report because I have a police report and I filed a fraud report, an identity theft claim, right? Now, the problem is if it gets investigated and it comes back that these weren't fraudulent, right? Then I committed fraud. By saying there was fraud when there wasn't, I just committed fraud. Okay, industry idiots will call this the credit sweep. So if you've signed up for credit and you bought the credit sweep, fair warning, you probably signed up for fraud. Okay, the other thing that'll happen is if you do these credit sweeps, they might not ask you to report it as fraud. They might actually have a direct data source with the credit bureaus themselves, and they'll log in and manually remove the items off your report. That's also illegal. Okay, and the reason I'm hitting this is something that happens rampantly right now. Like this is contributing to the current bubble, because what I could do is I could go get a bunch of 0% credit lines and charge them up and not pay them back, and then go through, a debt settlement with Freedom Financial, and I don't have any debts anymore because they got settled. Then I can go freaking report all of it as fraud and pull it off my credit. Nobody's the wiser, right? Except that's fraud. You're committing a crime. That is a financial crime. It's no different than lying on a loan for a mortgage. You can go to federal prison for that. Like, these are things that are happening that people don't realize. So if I'm trying to take things off, if it's fraudulent, I can take it off. If it's not fraudulent, I should not be saying it's fraudulent or claiming it's fraudulent or trying to insinuate that it's fraudulent, because that's a federal crime. That is fraud. So the stuff that's legit, we're going to do that with. The stuff that's not legit, we're actually going to use the Fair Credit Reporting Act against the agencies, against the credit bureaus. So we're going to take the fraud stuff off and the false things off and the identity thefts off and anything that's not actually supposed to be there. We're going to use a police report and an attorney to get all that stuff removed. The rest of it, let's say I did just have late payments and I did have some stuff that I wasn't on my game and I didn't take care of my credit and it's totally my responsibility. It wasn't fraudulent. We're going to send dispute letters through. Now, there's no magic behind this, right? You're just sending a letter to the credit bureau and we're saying, hey, we're disputing this item. Now, the rules are, if I send them a dispute letter, they have a certain amount of time to conduct an investigation and then come back to me and then say whether it was or was not an item that's disputable. Okay, if it's disputable, it means that they had inaccurate information or they misspelled something or they had something incorrect. Now, the good news is credit bureaus are rampant with that. They'll misspell your name, they'll misspell your address, they'll misdocument what you had. So by disputing, one of two things can happen. Number one is they might not even get back to us on time. They're so big and bureaucratic and slow moving that we'll send the dispute letter in. They don't respond in time. Now, legally, they have to take it off your credit. By law, they are required then to take it off your credit. Now, let's say that they do conduct an investigation, and a lot of times they don't. If they do conduct an investigation and there's anything inaccurate there, then they have to take it off your credit because it's not accurate. So it can't be there, right? So this process of disputing, we go through this, and a lot of our clients, this might take right now a dispute cycle of like a round of letters being sent out might take 30 to 60 days. So we do several rounds of this and we keep hammering away at the credit agencies disputing these items. And that's going to pull off everything that we can. So first we got off anything that was fraud. Okay, then we got off things that we could dispute. Okay, the purpose of this is we're going to go apply for new credit, but we can't apply for new credit until you're credit worthy. Part of solvency, part of wealth is being credit worthy. So when we talk about credit worthy, we're talking about a clean profile, meaning little to no late payments, right? We've got all the negatives taken off. We're talking about a 700 or higher credit score. Now, here's the other thing that I want to warn you guys about. If you're in the credit repair client position where you're talking to people about getting your credit fixed, we just talked about credit sweeps. Those are fraudulent. The other thing that's going to happen is there are ways to artificially attempt to manipulate your credit score upward. It doesn't actually mean you're going to get lending from people and debt from people. It just means that your score is going to look good. So two of the things that'll happen is you'll hear that you're going to buy primary authorized user trade lines, that's also fraudulent. You can't buy, like, a primary authorized user means that I signed up for a car. That's a primary trade line. And somehow you end up with your name on my car note. And then you get all the benefit of my car note. And I'm no longer on the car note. It's now your car note. That's illegal, right? The bank issued the car note to me. I can't reassign it to you without the bank's permission. That's fraud. So again, what will happen is you'll see people in the industry say, hey, you can buy primary authorized user trade lines and it's $5,000 or $2,000. And they overprice the crap out of these. And then you buy one and either you don't get anything, or if you do, like, you've officially committed a financial crime that you overpaid for. Right. And let's not be stupid here. Banks aren't idiots. So the idea behind this is if I buy a primary authorized user from somebody else, meaning they literally put me on their note and took themselves off their note, the note meaning the debt, the car loan, whatever it might be, the bank is going to see that. When they look at the history, they're going to see that this was added to my credit. And they're going to be able to find out that it came from somebody else, and then they're not going to count it. So yeah, my score might go up, but it does not mean that I'm going to get credit. Okay. And it also means that I did just commit fraud. So automatically when I do that, I'm not going to get credit. The other one that you're going to hear about that's you want to stay away from on this note is called an aged shelf corporation. That's where a LLC or an entity is formed and it builds up credit history for 5 or 10 or 15 years or however long. And then they'll basically deactivate the LLC. Like, nobody's actually running that business, but it still has credit history. So you might get pitched on buying it and saying, hey, if you buy this LLC, it has existing credit history, meaning that you can go get funding right away. Again, guys, banks are not idiots. So the bank is going to see that the LLC changed ownership on this date, and it used to belong to these people, and now it belongs to you, and they're going to not count any of the credit prior to that date. So you just paid $5,000 for an aged shelf corporation that's going to do you absolutely no good. Okay. So we're trying to get the credit score up, but we're trying to do it by legitimate means. Okay, so when we're getting it up, what this looks like is that we've taken all the negatives off, and then there's different factors that go into building a good credit score. Guys, these are not magic tricks. It's basic, like having good loan history, having long loan history, right? Having a variety of accounts, having low utilization ratios. We talked about taking all the negatives off. That helps too. Right. So when we get you to a point where you've got no more negatives, we start adding good lines of credit to your credit profile so that it builds up and it shows that this person has lots of different loans and they're paying them on time. And it starts giving you loan history that builds up over time, and you actually start building your credit. We're not artificially pumping it up with fake numbers. So the idea is we're trying to actually get the score really over 700 so that you can get funding. Okay, the other thing we're looking at is your debt to income ratio. Your debt to income ratio. What percentage of your income goes towards debt? Because I can have a clean credit profile and I can have a 700 score, but if I have a 50% debt to income ratio, I'm not going to get lending. I'm not going to get funding. And again, we're going after funding because the idea is as we're paying down your debt, we're going to get you 0% interest credit lines so that you can refinance out your higher interest debt to these lower interest debts. Then you can attack principal only. So it accelerates your sacred account debt buyout. It helps you pay down your principal so that you're in debt for a shorter period of time because less money goes towards interest. So we're trying to get you as credit worthy as you possibly can so that you can get debt that costs you less in interest and is easier and faster to pay off. That's the entire point of this, right? So we need to have a low debt to income ratio. If we have, 40% or lower, that's good. The lower, the better, right? And then the other thing is your utilization ratio. Utilization. So if I have credit cards, we kind of talked about this. I want the utilization ratio to be like 30% or less. Because again, if I have 10 grand in credit cards and I have a good score and good payment history and good debt to income ratio, but I've got 7,000 of my 10,000 maxed out, I'm probably not going to get a lot of loans. Right? So that's another thing. And then lastly, we want to make sure that we don't have a bunch of inquiries. Okay. Again, we kind of talked about this earlier. If I go and apply for credit and I have tons and tons of inquiries, they're going to see that and decline me. Okay. So these are all things that we're staying away from inquiring and getting credit, right? We're lowering our utilization ratios by paying off the debt. We're lowering our debt to income ratio. People actually ask me, with the sacred account, why don't we pay it off by interest rate instead of balance? Well, if we pay it off by balance, we do pay it off faster because we're freeing up cash flow. But the other thing we're doing is when we pay off a debt balance, the payment goes away and it automatically lowers your debt to income ratio. Automatically as a byproduct of doing this, right? So all of this stuff kind of adds up. Now, the final thing that we're going to do here is we're going to add something called a piggyback authorized user. I don't want you to confuse this with what we just talked about, which is primary authorized user. That means, and we talked about the piggyback before, but the primary is the one that's illegal. Like I had a car loan. Somehow I moved your name on my car loan and took my name off and I charged you $5,000 for it. That's 100% fraudulent. A piggyback is I have a credit card and my credit card allows me to add an authorized user. I can add my wife, I can add my kid, I can add my nephew, my niece, or you, right? So at the point where we've got everything negative taken off and we're adding good things and we're reporting good things, then we're going to add a couple, not a ton, a couple of authorized users on a piggyback trade line that are willing to let you be on their credit in a legal fashion. It's not illegal, in a legal fashion. And that's going to give you some of their credit reporting on your score. That's going to boost your score that last little bit. This is not the make or break. Like you shouldn't be paying $5,000 to get these. You should be paying a good price because that person is taking some risk. There's usually a broker involved. You're going to pay the broker that's involved as well. And the benefit is you might get a 20 or 30 or 40 or 50% or not 50%, 50 point boost on your score. Okay. Now again, you have to have other stuff on your credit because the bank isn't just going to look at that. They are going to see that that's not actually your trade line. They will see that that's somebody else's trade line. It's not illegal and it is good and it does report and it does boost your score. But if you have bad reporting history and negative items and you've got no credit diversification on your report and you don't have very long history, they're not going to be like, oh, they bought 7 authorized user trade accounts of people that had great credit and their score went up. Of course, we're going to loan the money. No, they're going to say this person took the equivalent of steroids for their credit and none of this is real. So we actually do have to have a good base foundation laid. Okay. Now, once we've got all of that, and this part's dope, this is sick how we have this set up, we're going to get 0% lines, right? 0% lines. Now, you could do this on your own. The problem is a lot of these banks communicate with each other. A lot of these banks need to know certain information and reasons why you're getting credit. A lot of these banks are going to look for certain behavior and also certain things you say to them on the phone and in your application to get credit. So if you apply by yourself, probably what's going to happen is you're going to get 10 or 15 grand and then get shut down. You're going to max out and then you end up with a bunch of hard inquiries on your credit and it's going to destroy your score. Okay. So we have our own underwriting and funding company that we work with. This is an exclusive agreement. Nobody else in the world has this. You can pay people to get 0% funding. Like they'll go and they'll apply and they'll go to the bank and they'll find out who to apply with, when to apply, what to say, how much to ask for, how to respond to underwriting. And they'll do that for a fee. Now, anyone that's ever gotten 0% financing, you already know the success, they call it a success fee. The success fee is not cheap. Usually they're going to charge you 10 to 15% of what they got you at 0%. Which makes no sense. It makes absolutely no sense. Because if I'm trying to get my interest lowered, my average interest rate is probably 15% on all my debts. Meaning I'm paying 24% on credit cards and I'm paying 5 or 6 on a car, 7 or 8 on a student loan, 6 or 7 on lines of credit. That all balances out to about 15% that I'm going to pay on my median interest rate, which means if I get 0% credit, but it costs me 15% in success fees that I'm paying to a broker to help me get there, I have actually made no financial progress. By the time I've paid them their success fees, it's the same cost I would have paid in my interest. So that's the other thing to watch out for, guys. When you're doing funding, you should not be paying people 15% and 12%. That's like robbery. That is the slimiest, scummiest, like they're taking advantage of you because you see 0 and don't realize, well, I'm paying them 12. So I'm not actually saving anything. Plus, usually I end up having to pay balance transfer fees, which is another 3 to 5%, or transaction fees, which is maybe 2 or 3%. So I might be paying 17 to 20% by the time I get out of this, right? So this is all stuff to consider. What we have set up here, and this is awesome, is we have an exclusive agreement with what I believe is the best funding organization in the United States. Your success fee to them is 4%, meaning they're going to get you credit at 4%. That's it. They're going to get you 0% lines of credit. They're going to charge a success fee. What they're going to do, though, is they're going to give you the bank list. So this is why we work with them. They give you the bank list, all of the institutions to go to get 0% credit, what to say, how to handle it. If you get stuck, they're going to jump on a call and coach you through it. They're actually going to consult with us on improving your credit so that we can see what needs to be done, what needs to be added in order to make this person the best they can be when they go speak with the bank. So they're doing everything that they can possibly do to help, and it costs 4%. So the reason why this is great is because if your average interest rate is 15 between a 10 or a 15 or 20% credit cards, and your student loan that's at 7%, and your car payment that's at 5%, all this stuff is higher than 4%, right? So if your net cost on this is 4%, you're winning. You can now take all of your debt and refinance it over here. And instead of paying 10+% in interest and all this stuff, which takes you longer to pay off, you're only going to pay 4. And then we can freaking throw down with the sacred account and get all of this stuff paid off. Okay. Now, the benefit of this is while we're doing this, not only are we paying off your debt faster, but we've also now increased the number of lines you have. You've got good payment history on them. We're paying them down. Okay. And so this actually strengthens your credit score. Okay. Now, once you're out of debt, we're really not going to play with credit that much anymore. We're going to use it for asset-based lending. This is the other thing I want to cover. Okay. When you are getting financing, they're going to look at a couple of areas on, do I finance this person? The first thing is they're going to look at, do you have assets? Okay. These are called collateral-based loans. The bank is going to say, this is why they'll give you a mortgage. They're going to say, do you have an asset? If you have an asset, then we can extend more credit to you than we usually would, because if you don't pay us, we're going to take away the asset, right? So do you have an asset? Okay. If you don't have an asset, then they're going to look at your income. Okay. Can you secure this loan with your income? This is why student loans are a thing. An 18-year-old can go to a $50,000 student loan with no assets, because the student loan bank is going to say, if you secure this with your income, then we'll loan you money because we can garnish your wages. So you're going to have income if you don't have assets, or you could have both. If you don't have income or assets, then you have to have track record. Okay, this is your credit report. Okay, AKA your report. So if you don't have assets and you don't have income, then they're going to look at your report. They're going to say, what does your report look like? This person doesn't have the income we like to see. They don't have assets that we can take away if they don't pay us. So what is their history with paying cards and stuff, right? So when you're broke, you didn't have income, so you had to borrow money. That means that it went on your credit report. That's why the report is down. That's why we're fixing it. That's why we're doing all of this. Once we're broke, we're not doing that anymore. We now have income and we now have assets. So when we go to banks and we get loans, we can then say, hey, we have assets and income. You can give us better rates now, and you can give it to us on better terms, and the loans can be easier, right? Now, when we start doing this, though, this is not on credit cards. If you're doing asset-backed loans, you're loaning against a thing like real estate. Okay, this is why I hate when I hear people say OPM, other people's money. They're leaving out the very important piece of, it's not just other people's money, it's me using my own collateral to get other people's money, right? So you hear people talk about use debt, use leverage. Yeah, but they're leveraging against an asset that they already own. So they're not just going to the bank and whipping money out their butt and then buying things. They're saying, I have a asset, a piece of real estate, and I'm going to go to the bank and say, hey, can I borrow 80% or 90% of the value of my real estate to get money from you guys, where I can keep the real estate and I can get the loan, but if I don't pay you back, you're going to take away the real estate. That's an asset. That's not just other people's money. The key is I had to have the asset first. It's not just go borrow money and you magically can go make money off it. No. Get the asset first. then you can use debt against the asset. It's not the other way around, right? So I can do that with real estate. I can do that with life insurance. Okay, I can do that with gold. I can do that with equipment. Okay, these are all things that I would own first. I would buy these first, and then I would be able to borrow against them and use debt, use other people's money, but I had the asset first. Okay, when you get solvent, meaning we've paid off the debt, we've fixed the credit, we've done all of the things we talked about tonight, we're no longer going to use unsecured debt to do things. Like, sure, you can pay bills on it and get airline points, but you're going to pay that card off at the end of the month, every single month, even if you die. You're going to do it no matter what, right? Now, the other thing we're going to do, though, is we're going to accumulate gold. We're going to borrow against the gold, but that's different because we owned gold first and we're securing it with that as collateral. We're going to buy real estate. We're going to borrow against the real estate, but that's different because we owned the real estate first and then we're securing it as collateral. We're going to own life insurance and borrow against it. Same thing. We owned life insurance and then we borrowed against it, which is different than I own nothing, but I'm going to go borrow something, right? Now, the other final thing here, and this is way up the blueprint. This is like very like when you become what's called a sophisticated investor, we're going to help you get business credit. Now, this is something that we purposefully don't help our clients get till they're sophisticated investor. Sophisticated investor means you have a $250,000 net worth, right? Prior to that, you're not allowed to do most of the things in the investing world. So if we give you business credit, meaning an entity or a corporation or a trust gets credit that's not attached to your personal identity or your personal social security number, what the hell are you going to do with it? You're not sophisticated. You don't have access to deals yet. So if I get 250 grand in business financing and it's not attached to my personal identity and I don't have anything smart to go do with it, guess what? I'm either going to do nothing, which means I wasted money to get that credit, or I'm going to do dumb things. So we get someone sophisticated first. Again, $250,000 net worth. Once they have that, we help them set up a funding entity. You're now going to go become your own funding entity. The entity can be an LLC or it can be a trust. It's going to be an entity, some kind of corporation or trust, right? This is now going to get its own business credit. This business credit is not attached to your personal social security number. It's actually easier for you to get once you've built up your profile to get it. And it's something where if you can't pay it, again, most of this is going to be asset backed. If you can't pay it, it's also considered non-recourse, which means they can't come after you and they can't come after your entity. They're just going to take away the asset you secured it with. Okay. Now, this might sound like too good to be true, which is why we have you wait till you're here. Because a lot of people that are watching this, and maybe some people that aren't watching this, but I can think of people right now that they would be like, oh, sweet. So I'm going to get 250 grand. It's non-recourse. I don't have to pay it back. So I'm not going to. Guys, we're not going to help you get wealthy so you can steal from a bank. That's not how this game works, right? So when we do get to the point where we're using leverage to invest, it's going to be business credit because that separates the liability away from you personally. Okay, this is the thing, because everyone that I see that's doing credit is doing 0% credit cards and trying to buy real estate and invest in their business and flip properties. And that's fine and dandy, but you're taking on 100% of the personal risk by doing that. What I'm saying is get solvent. Clean up your personal credit. They're not going to give you business credit if your personal credit sucks. Okay. Then when we get you to the point where you actually own assets, you've actually done deals with your own money. Don't even think about using other people's money if you've never even used yours before. You are other people's money. You've been giving it to everybody. So use your money for a change. Build up some assets there. Then when you've got your legs under you and you can take a couple of hits with investing, let's take you to get your funding LLC, get some business credit, and then we can use other people's money, but secured by real assets. Okay. This is how credit works, guys. This is like, and nobody is teaching this. So I only know one guy that I've ever talked to that agrees with me on these things. That's actually in the credit and funding business. Everyone else is selling, credit sweeps and primary user trade lines. The other one that I want to hit really quick on this is called a CPN. These are all things you guys should stay clear away from. A credit protection number. This is also fraudulent. This is a an entity ID number, just like you would get an EIN for an LLC. You can get a credit protection number. And this basically makes it to where when you apply for credit, it goes on this number instead of your social security number, which is again, fraud. Like you don't want this in your credit life. You don't want to be committing fraud. You could actually go to a lawyer and get this if you legitimately need one, and they'll help you get it legally. But if you're going through a credit repair agency that's telling you get a CPN, run the other direction. They're telling you to commit fraud. Okay. So these are all things that let me get my Facebook lighting back up. These are all things that we don't know until we know, right? Like when I first started learning about this stuff, I had no idea, let alone even how to have credit and get good credit. I didn't know about don't get CPNs and don't get primary trade lines and don't get credit sweeps and how to build good credit and take off negatives. I didn't know about the Fair Credit Reporting Act. I didn't know about how to send dispute letters. I didn't know the difference between business credit and personal credit. Why in the world would I have all of this stuff on my personal credit? I don't want that liability. I don't want someone to be able to come after me and my family because something happened with my business or my investments. That's why we have LLCs. Why wouldn't you separate the risk on your credit too? So guys, I know this was a lot tonight, and I wanted to give you this because this is, again, it's an undercut, okay? So I'm not all of a sudden the social media scammy credit guy. Like, this is stuff we're going to cover. It's a very small part of you becoming solvent. And then once you're solvent, we're not going to use it a whole lot. And then once you become a sophisticated investor, we'll use it, but we're going to use it in a different function. It's not going to be personal stuff. So what I want to do, guys, is I want to open this up for some questions. I want to just see what questions we have out here tonight. All right, let me see what we have on Facebook here. I don't see a lot of questions on Facebook. I think most of you guys switched over to Zoom by now. Let me see what we have on Zoom. Chris says, someone on LinkedIn offered me that 5K primary account transfer deal. Yeah, Chris, that's 100% illegal. I hope you didn't do that. If you did, talk to me and we'll get that handled and taken off because you don't want that on your report like that. Okay, good. He didn't do it. Chris didn't do it, guys. Good job, Chris. Chris is a smart guy. I didn't think he did it, but you never know. What other questions do we have on Zoom here? So Nano is asking, what is considered a bunch of inquiries? I mean, if you have more than like 3 or 4 inquiries in like a 6-month period, that usually is not going to look good. It doesn't mean you're going to get declined on everything, but it's basically like you're getting into the point where people are going to say, hey, why are you asking for so many loans? One of the ones that you need to be careful of is when you go buy a car. Okay. When you go and buy a car, a lot of times the car dealership, when they're shopping your loan, they'll send out a loan request to like 30 different banks to get the best rate, which kind of makes sense. But now you also have like all of these inquiries. So you want to make sure that you're not getting involved in that too. So too many inquiries. I would say if you're getting more than like 4 to 6 in a 6-month period, that's too much. What type of debt? What would the type of debt on the credit be used for? Once debt is there, how long should one allow debt to be there? And should I aim to pay it off free ASAP using income? So I think he's asking about when we refinance the debt. Okay. So when you refinance your debt out, we get 0% lines and then we pay off our higher interest rate debt so that we have 0% lines that we're paying off. Basically, that's the type you would do it with anything that you know you could pay off. The 0% period is only going to be for 12 to 18 months usually. So you're going to look at the math and figure out, okay, which of my debts do I know for sure I'm going to have paid off in the next 12 to 18 months, and I'm going to refinance them out at 0% on those ones. Okay, so if it's like 300 grand in student loans, I probably don't want to do that on 0% credit lines because it's going to take me longer than 18 months to pay off. And if that 0% intro period goes from 0 to 24% all of a sudden because my 18 months expired, that's going to freaking suck. I don't want 300 grand at 24% revolving interest on a credit card. So I'm going to size up in the 18 months or in the 12 months. What are the debts I know for sure I'm going to pay off? And I'm going to use just those. Once debt is there, how long should one allow debt to be there? Or am I paying it off ASAP? So you're going to pay it off ASAP. You're never going to let it sit, right? If you're in debt, you are getting out. That is your main focus. You're in financial prison. You're living literally in the past when it comes to economics. You can't make future progress when you're economically in the past, right? So we're not doing investing at this point where everything we have goes towards the debt. When is the point to ask for 250 in credit? So again, that's when you're a sophisticated investor. So we're going to, at that point, have built your credit up, your assets up, everything will look very good. And then you're going to be able to get business credit, which at that point you can get, 250 to $500,000 or more in business credit. But again, we're not going to help broke people get that. We can, we're not going to. It's possible, we're not going to allow it. That's a personal ethics decision, because I'm not going to be the one that has to walk you through, shit, I just borrowed 250 grand and didn't pay it back. What do I do, Jerry? Like, that's not the conversation we are ever going to have. What ducks have to be lined up to do that? So I kind of explained that. Become a sophisticated investor. That's on the blueprints. Robin has a question. How do you lock your credit so they cannot do inquiries? So Robin, that's easy. If you go to like Experian, I think you can do it through FICO.com as well. You can do a credit freeze, like you can lock the credit. What that does is it makes it to where nobody can inquire on your credit because it's locked. So it's kind of like putting a firewall up around your credit. When the inquiry comes through, boom, shut down. You have to actually unlock your credit for the inquiries to be able to be removed. So you can do that through Experian. You can do that through myfico.com, I believe. Experian, I think it's like $30 a month to have a membership there. Same with MyFICO. But please don't pay someone for that. So if someone's like, hey, I can help you lock your credit for $500, go the other direction. That you're being preyed upon at that point. All right, let's see if we have any other questions. Griffin says, why do people think they are not legally obligated to pay taxes other than idiocy and low income? So Griffin, this one's a little bit of a bunny trail. So income tax actually is not constitutional. It's not constitutional. And if you start researching it, it's not legal. Like legally, you should not have to pay income tax. Now, the problem is it's enforced. So whether it's legal or not legal, it's enforced. So if you don't pay it, if you look up Peter Schiff, his dad, I forget his dad's first name. I think it's Erwin Schiff. He actually went to the Supreme Court and argued that. He said taxation is not constitutional. And because it's not constitutional, I'm not going to pay it, and I'm going to fight it in court. Even though he was right, he was wrong, because it's the cartel you're dealing with. It's kind of like being like standing up, if you were like in the 1930s, like standing up to the mobsters in like New York or Chicago. It doesn't matter if you're right. They're still going to beat you up with a baseball bat because they can, and nobody's going to stop them. The IRS is that with taxes. So even though it's true that taxation is not constitutional and that it's not legal, and by the book, you shouldn't have to pay it, if you don't pay it and you don't actually like use the tax code to not pay it, because there's a difference between me just saying I'm not going to pay taxes, or I'm going to use the tax code to not have to pay taxes and legally do it. If I do it this way, I'm fine. If I do it this way, even though I'm right, they're going to beat the shit out of me with a financial baseball bat, stick me in prison for the rest of my life for tax evasion. So I hope that answers your question. And that's a little bit blunt, but it is the truth. And you'll see plenty of people that say they just have opted out of income tax. They just haven't been sued by the IRS yet. What that means is they just stopped paying taxes. They opted out. They said they're not going to. At some point, they'll get audited and sued, and they'll have to pay it. And if they can't, then they'll go to prison for tax evasion. Robin says, I have excellent credit now, so do I need to lock my credit for inquiries? Robin, you definitely can. You don't have to, but you can. A lot of people will do that. Now, again, like if you're in an environment where you're going to be using your credit and transacting, like just be aware that you need to unlock it, right? If you're going to buy a car or you're financing something, unlock it before you go. Otherwise, you're that person that's like, oh, sorry, I couldn't do the loan because my credit was locked. Like you don't want to be that person either. So you can lock it. You don't have to lock it. If you have a good credit reporting service, I have one that I use called ID Shield. They tell me when stuff happens on my credit, I can freeze my credit and lock it through there too. But just be aware of when it's locked, when it's not locked. It's not something that's a necessity though. Chris says, great presentation. Thank you. Let me see if there's any other questions or comments. I think that's it, guys. So I hope that you enjoyed this tonight. I definitely did. Next week, I hope Facebook is up and running. We did not get the Zoom Facebook connection this week. So if you're on Facebook, I don't think we got the same boost and exposure we usually get. So please share the stream, get this out there. I can't tell you how many people are losing in credit right now in life because they're financially irresponsible, A, and then B, because they're being taken advantage of by people on things like credit sweeps and our primary user trade lines and CPNs and credit, age shell companies and all this garbage that's out there. So by sharing this, you're doing people a big favor. So share it out. Make sure someone sees this if they need to. That's all I've got for you tonight. Make sure you like, share, and subscribe, and I will talk to you guys next week.